Welcome to the Do More podcast, where we share strategies and tips for improving your life in every aspect. Here's your host, John Farling.
All right, everybody, welcome back. Today I've got a newer friend of mine that I met in the newer, real estate mastermind that I joined last fall. And Mike Bowe, welcome to the show. Why don't you tell us a little bit about yourself?
Thank you, man. Yeah, it's good to be here, and it's good to come across your path, man. Like you said, we met at the mastermind that we're both part of, and it's been super cool to get to know your story and everybody else in that group. But my story starts about 2013 is kind of when it started. Long story longer. I was kind of like everybody else, working the job, doing the American dream, and I walked into work one day and got sat down and said, "Hey, you don't have a job. You got to find a new job within the next 30 days. You don't have one." It got eliminated. And
what were you doing?
I was working retail. So I was working at one of our local retail stores here, just kind of something I started doing since I was 16. And it was, work your way up, and was in the management position there, and thought, was doing pretty solid. And, to add things onto that, my girlfriend at that time, my now wife, was at home on maternity leave with our 3-month-old son. We had just bought a house, and so it's kind of a unique situation, but it kind of led me down a path of, thinking about things a little differently. So it was good.
Yeah. So I love looking at like different trajectories of people's lives, and obviously that was one of them. So what happened? So sound like you're at least moving up the ladder. What you're doing in retail, you were fired, let go. What happened from there?
Yeah. So thankfully, I didn't actually lose my job. I found something else in the company, but like that feeling never left, right? That feeling of, somebody else having control over your financial future, your family's financial future, really never left. So sent me down a kind of a long winding path of, I found Dave Ramsey, and I thought that was kind of like the best thing, right? Beans and rice and beans, started paying off a bunch of debt. And at the end of the day, I didn't like the fact of, working until you're 65 and, dying 10 years later. So I went down a couple other avenues. I looked at, stock trading and, the value investing, kind of the Warren Buffett, Manesh Prabrai, like concentrated portfolio strategies. But then again, at the end of the day there, you would make a really good call about a company. You'd buy their stock. They would, beat their, expectations and raise their guidance, and then like a CEO would say something stupid and it would tank the stock, right? So, that wasn't for me. I wanted something that had a little bit more control, and like a lot of us, ended up stumbling across the Bigger Pockets podcast and the forums, and just clicked with real estate. So I found real estate in 2016 is when I found it. Bought a duplex in 2018. Decided commercial real estate was maybe more up my alley and my skill sets. So about a 24 unit with some partners, about an 8 unit, 28 unit, and a 77 unit, and then jetted the corporate world somewhere in between that journey.
Oh, wow. Okay. We went really fast there. So 2016, you got your first duplex. That was your first real estate investment property, right?
Yeah. 2018, we took a HELOC on the house, bought a duplex, really just didn't know what I was doing, but stumbled along far enough, and bought that duplex in 2018.
So take us down that path, because I know, and I've got some buddies right now that are trying to work their way to getting into real estate investing. I've used my HELOC from day one too. So one, how'd you find the deal?
Well, so this is back in 2018. So it was on the MLS. It was sitting there for a little bit, and we made an offer that was a little bit lower than they were advertising it for, and it's just been sitting long enough, and it made sense. So found it on the MLS, put a little bit of a value add in it, fixed up one unit and rented it out, had good solid tenants in the other unit, and it was cash flowing pretty decent. So found on the MLS, but made a lot of mistakes. So made a couple mistakes that were in the range of $10,000 to $12,000, which was fine, because at that point in time, that's kind of why I tell people you shouldn't overextend yourself, because like you want to take your lump small. Had that mistake been on $1 million property that was $100,000, probably would have taken me out of the game for a long time, right? So it was pretty vanilla, straightforward, small multi deal.
So you used your HELOC for the down payment, or to buy the whole thing?
So I used the part of the HELOC and then part of cash that it was saved up for the down payment. So yeah, just put 25% down and purchased it a combination of cash and HELOC.
Gotcha. Was there any rehab? Did you say there's rehab or no?
Light rehab, yeah. So one unit was basically ready to roll and occupied, and then other unit we did some light rehab, so some cosmetics, some deferred maintenance, things along those lines, but nothing too crazy for the first deal. The big mistake was we had HVAC that we had to replace. You ever heard of a gravity furnace?
Yeah.
Octopus furnace? Yeah, dude, those things are wicked. So we had to replace one of those to the tune of a little around $10,000, but.
Yeah. What did you do the rehab yourself?
I did. Not the HVAC. I did some of some of the light cosmetic stuff myself, which was a learning in itself, because like my strategy, my power is behind a keyboard, not a hammer, right? So like I'm not a handy guy, but I was too cheap to go hire somebody out. So it was many trips to Home Depot, lots of YouTube videos, and at the end of the day, had a worse product than had I just paid somebody to do it. So that was a big learning in the power of a team, and in the power of knowing your skill sets and knowing where you lack in skill sets. So attempted to do a lot of the reno, did the reno, but probably was not the best bet.
Right. Yeah, but you learn from it, because I know you're not doing that now. I mean, I had a similar path. My first rental, I did everything, and it was not a light rental. I think it took me 5 or 6 months of every day being over there. So you did that. You finished that up. Was that thing making money after, right away, or?
Yeah, it was cash flow positive after we updated that one unit and put a tenant in there, and it was cash flowing pretty decently. I think the only negative is what I was doing is I was looking, kind of extrapolating what that cash flow would look like, over the years, and how long it would take me to kind of build up a down payment to get that next one. And it on paper, it looked like it was going to be impossible to scale as fast as I wanted to scale to make it truly impact on our family's trajectory, right? Like the goal was to replace our income and to get this like base level financial freedom. And it just looked like it was going to be really hard to do with small multifamily. So it's cash flowing, but it just wasn't moving as fast as you want. And I think a lot of us as real estate investors, we do that, right? We get a property with the excitement of the deal, finding the deal, closing on the deal, and doing the reno, and then it's stabilized, and it's like, well, it's kind of boring. It's cash flowing, right? But like, there's like, then you need to do something else. So yeah, it was cash flowing decent, but it just wasn't getting us to where we wanted to get to, I think.
It didn't make an impact. So what'd you do from there?
Well, I had it for 9 months. I bought it, fixed it up. The goal was to buy it and not ever sell it, right? And just kind of continue to cash flow. But I started getting around people in the commercial real estate space. I started getting involved with some other masterminds and communities with apartment complexes and larger multifamily, and just realized like my skill set was probably better suited there, with how those properties are valued, how you can expedite your growth a lot faster from an equity perspective in those properties. So we sold it. All in, we probably cleared, maybe 15, maybe 16 grand on it in that 9 months. So it's not like we killed it on that, but we got our capital back and learned a lot, and then rolled it into some larger multifamily down the road.
Oh, nice. So that's interesting. So that's probably a little different from what I hear from most people, is especially their first deal. They're going to hold on to it for a few years. Especially, you put your blood, sweat, and tears in that thing, and you're able to unload it in 9 months. I don't know many people that could do that. Most people, they build an emotional attachment to it. So how do you think you got over that?
Yeah.
fact?
I mean, that's one thing that I am pretty good at, is like, I'm totally cool with changing my mind if I learn new information. Right. Mm-hmm. And I think sometimes people get too stuck in their ways of like, this is what I had decided on doing. This is what my goals were in the beginning. So I'm sticking to it. Right. But as I learned more about larger multifamily and about how you can force valuations and force equity in that space, I just knew that was better suited for what we wanted to do long term. So I was totally fine, folding the cards in and saying, we learned a lot, and the plan was to originally hold this for a long period of time, but things have changed. So I think that's something that a lot of people got to look at as new information comes up. Don't be afraid to change course, and don't be afraid to adjust things as you need to.
For sure. So were you working full time at this point?
Yeah, man. So I so since 2013 with that phenomenal fun scare of, almost losing my job. I ended up working in the stores for a while and moved up to our corporate office. So it was kind of doing the 9 to 5 thing in corporate America. And I was working in corporate America really until we got 60 units. So we bought that duplex, we bought and sold that pretty quickly, bought a 24 unit, bought an 8 unit, and about a 28 unit. We sold the 8 unit after that. And then, it was 60 units until I decided jet the corporate world.
That's crazy. So how did you do that? Because I'm assuming your hours were 9 to 5, right?
Yeah, like 7 to 5 plus, some weekends and some nights. So the COVID really, because this was all, when was it? Yeah, 2020. So I was still in the corporate world during COVID, and COVID really kind of shook the corporate world and made it. Dude, it just changed it dramatically, right? So instead of 9 to 5, nobody would ever put a meeting on your calendar at 6:00 if you guys were in the office, but they'll sure as hell put a Zoom meeting on your calendar at 6 p.m. and 7 p.m. and 7 a.m. So it just got chaotic, and there's no boundaries, with work from home right when COVID kicked off. So it sucked, but at the end of the day, I think it always sucks right in the beginning, right? The hardest part is those first couple of years when you're your portfolio is not nearly enough to support you, but you still want to continue to pursue it because it's the better path long term. So just
that's crazy,
grinding through a lot of
I want to know more.
Nights, long days.
Yeah, how did you juggle a 9 to 5 for that long and build 60 units? Build a portfolio of 60 units. That's a lot of work.
Yeah, but when you're, I like I said, I never lost that feeling of having somebody pull the rug out from under you. So that was kind of the driving factor, and still is. So that when you've, it's kind of cliche as all hell, right? But when you've got a big enough vision, when you got a big enough why, it doesn't, not like it's not work, but it makes it a lot easier, right? So a lot of long nights, a lot of long weekends. But I knew kind of what that North Star was and kind of what what that would provide, right? So a lot of people, if they don't really kind of tie why they're getting into real estate investing or why they're doing the venture that they're doing back to really ideally a feeling, right? A feeling of something that happened or a feeling of something that you're trying to get away from or to, then it's not going to be as easy to push through some of that shitty time.
Yep. No, I agree. And that's so powerful because I think there's so many people that, and I'm sure you run into it, that I run into that are it's something I think I'd like to do or I want to do. No, this isn't something you just wanted to do. This is how you lived your everyday life. You didn't want that feeling of someone else controlling your destiny. You're like, I need out. Yeah. And you saw a path and you use the pain. And you said you still use that to this day for motivation, right?
Yeah, I have to remind myself about it because, being, 11 years removed, it's sometimes you can find yourself getting a little lax, I think, sometimes, me personally. But reminding myself of that all the time is something super key. And I think a lot of you're 100% spot on. I run a small real estate team that focuses on investing here in Minnesota as well. So I run across people all the time who want to get into real estate investing, think they want to get into real estate investing, the idea of getting into real estate investing. But at the end of the day, a lot of those guys peter out and a lot of those guys never move forward because there's not enough pain or there's not a big enough vision. One of those two is not pulling them forward fast enough because it's not an easy path, right? As building a self-storage portfolio and, doing something that is out of the ordinary between, what 99% of Americans do, you run against a lot of friction and it's not easy. So you gotta have something pulling you forward.
Yep. 100%. That's awesome. So I do want to dive into how you found, well, obviously you've grown your portfolio since then, but I was looking at multifamily. I probably started looking at 16. I couldn't make anything pencil out. Now, obviously there were people buying back then, buying up till now and buying now. People are always buying, but you were in a very hot market. How were you buying deals from 18 through now?
Yeah, it did help. We went off market for a couple of them, which helped. So we bought our first 24 unit. We found it direct mail and then followed up with a cold call. So that was phenomenal. We bought that thing for 1.6 and got it valued at 2.7, a little under two years later. So that was a good deal. Found it off market. So we didn't have any competition on that. And honestly, we probably wouldn't have closed it if it was on market. We were so new at that point in time. We were fumbling over every step of the acquisition. And the only reason we got it to the finish line is partially because of partner and partially because we were just dealing with the seller, right? Had we been dealing with a broker at that point in time, they would have spotted the amateur hour that was going on there and probably would have moved it to somebody else pretty quickly. But I guess that's the benefit of going off market too, is you got a little bit more leniency there. So that definitely helps. Off market, so you can have less competition, and then relationships, right? So even in the stuff that we bought on market, we built up some really good relationships with the brokers in our market, and we're able to see things pre-market, so like 4 or 5 days ahead of when it was going to the market. Some of them like completely off market, and all of that helps get a little bit of an edge, especially in a super competitive market when you're talking a couple days and hard earnest money and quick closes and things like that. If you've got a jump of 7 days on something where you can dial in your underwriting and your expenses and your budget and things like that, then that helps a lot too.
Yeah. So I did off market letters too for multifamily. I couldn't find anything. I'm sure you weren't the only one that was mailing these people, or maybe you were. So why do you think your letters worked? And did you have other competition that you knew of?
No, we didn't have any competition that we knew of on these specific deals. I think the letters work, and they're like, it's a low response rate, right? It's definitely a numbers game, but it is consistency, right? Like if you're going to send out one mailer and be done, like you're probably better off spending that money elsewhere, right? But we hit it pretty consistently over a few months, and then we also double tapped it and followed it up with a cold call. So we basically took that list and we worked it on from a couple different angles. And the letter is not the one that got him. We got him on the phone, and then he had remembered the letter. So it kind of like that dual approach really helped. And then I do it's a decent amount of direct mail here. And I think a lot of people don't spend nearly enough time on the copy and the presentation. So a lot of people just throw like the templated postcards out and send it to a massive list of, non-owner, like vacant absentee owners or whatever, right? Well, you're like one of 1,000 people that are mailing that list with that same templated postcard that just hits the trash, right? So I spend a lot of time writing copy on my letters to make it stand out and make it unique. And then I do it, any direct mail, I always do like a stuffed letter. The first class mail, I don't do it myself, but there's companies that make it look like it's a handwritten address and have an actual first class stamp on there. So, and it's not expensive. Like it's like $1.10 a letter versus like, 50 cents on a postcard. So you definitely get a lot more response rate for things like that and spending some time on the copy.
How many letters are you sending out, and what makes your letters stand out? Do you have like a sentence, or I know you said you worked on a lot, but what makes yours stand out?
Yeah. So probably a couple thousand every month or two. Probably every 2 months. So, cause I have a few lists that I hit on a regular basis. The copy, like your presentation aside, right? So actually I wonder if
you don't have to show us your full letter.
I had it here somewhere, but no, it's a green envelope, so it sticks out a little bit versus like your white envelopes. It looks like a handwritten note, a handwritten address on the front, and then the copy on the inside of the letter it starts off with, "I know you get a lot of these. I'm not a wholesaler. I'm not a flipper. I'm not trying to buy your property for cheap. None of that garbage." And I think that kind of like breaks down a little bit of like the defenses from the sellers if they open it, right? So first step is they've got to open it. So you got to have a letter that looks a little bit different. Like I said, first class stamp, looks like handwritten. So it looks like they're getting like an invite to a birthday party, something like that. And then maybe there's a little bit of they might be upset when they realize it's a marketing letter, but at least you got them to open it. And then, I have that first sentence of, "Look, I'm not trying to buy your property for pennies on the dollar. I'm not one of those pesky wholesalers that are trying to flip this thing and just get it to, put it under contract, tie it up, and then, back out on you." So really kind of break down that initial like walls up from these sellers with just, "Hey, we're local investors trying to buy properties. We'll pay you fair price. And, we're not Blackstone, but we're not a wholesaler either." So really just trying to differentiate from the thousands of letters they always get,
Yeah, no, that's awesome. That's there's a ton of good nuggets in there. Like anybody that's doing direct mail marketing, re-listen to that again. That's absolute gold. How are you still following up with phone calls with those letters?
I'm not personally.
Yeah.
I have hired a couple outreach companies to do that. But yeah, they hit that, I don't know now, maybe once a quarter. So it's not too crazy, but yeah, the letters are kind of the main source to get, calls coming back in.
Yep. Yeah. No, that's awesome. And I've done a little bit of that on a much smaller scale, but the money's in the follow-up.
Totally.
Where are you finding the phone numbers?
Yeah, so all the systems that I use, I use PropStream to get pull the addresses, because I think the PropStream is pretty cheap software. It's $100 a month, and you can pull your list and cancel it if you want to. They probably don't want me to say that, but you pull the list and you cancel it if you want to. But it really kind of allows you to fine tune your list location wise. What size, how long people have owned it. If there's what the mortgage balance is on it, things like that. So I use that to get my list. And then Fiverr is like the best thing since sliced bread. You can find anybody on Fiverr doing things. So there's a company called Skip Ease that I've used on Fiverr. So I just pull my list off of PropStream. I upload it to these guys on Fiverr, and I'm trying to think of the price of it was. So like a list of like 900 to 1,000 addresses are right around $100, $120 to get it skip traced. So you get all the phone numbers, you get the emails, and they're not perfect, but it's between like 60 and 70% accuracy. So and then I get that, and then I use a company called Go Big Printing to do the direct mail.
That's awesome. That's a ton of awesome information. I want to get into what you do, but I want to get back to your story. So sounds like it was in 2020 when you had 60 units.
2021, I think, is when we get to 60.
Okay.
Yeah.
And then since then, what's happened?
We bought and sold at 8. We got a 77 last quarter, and we've got 3 properties at 129 units right now.
That's awesome, man. And where are they located?
Tucson, Arizona.
All of them are.
Yeah. So I started buying in Minnesota. I don't know. I live in Minnesota, man. I started buying in Minnesota. That was where the first duplex was. Like I said, like I'm not a handy person, but I was there all the time. I had a young kid at the time, and like it was just not worth my time to be there. But like I was too stubborn to hire a team, so I'm like, well, shit, I'll just buy across the country, and then I'm forced to hire a team, right? And forced to hire things out and buy deals deep enough where it made sense to pay contractors instead of me doing the work. So that was kind of the initial urge to go buy in a different market. That and landlord tenant laws kind of suck in Minnesota, so I didn't love that thought. So, but both of those made me go to Tucson, Arizona.
Gotcha. Okay, so you've scaled that, and so a lot of listeners I think are in self-storage. I myself in self-storage in a way I kind of remotely manage. I don't know if there's a ton of people, or at least maybe they don't talk about that, and maybe you can correct me, that are in multifamily that remotely manage that far away. Is that a common thing in multifamily?
No, and so I don't remote manage. We've got a property manager down there in all those properties, right? So third party manager. Yeah, which is there's a lot to talk about there, but so we have a third party manager. I meet with them once or twice a week and run over all the KPIs and kind of the workings of the properties and kind of our plan for the properties and things like that. But not one who is remotely managing. Now, speaking of the group that we're a part of, there's a couple guys that I've talked to that we know that self-manage from afar on multifamily that have got me thinking a little bit about it, because I think that's a big opportunity. And third-party management in my size of properties that are anywhere from 20 to 80 units, it's really hard to find a players in the property management space. So that's been getting my gears turning a little bit over whether or not that's an opportunity. But
yeah, is this the first one that you found, or have you gone through multiple property managers?
We've gone through 3. Mm-hmm. So we are on our 3rd property manager. They're okay. They're not fantastic. I should say we've got 2 different property managers because we got different size assets. So the one that we've got on our larger asset is pretty phenomenal. And then on the smaller side, because some managers just don't take anything under, 70 units or 60 units or whatever. Those guys are, C+, B-. So there's some opportunity there, but it's just hard to find somebody in that C+, B-, 20 to 40 units to really like knock it out of the park with property management.
Right. I want to ask, how are you going to possibly do remote management? But I don't know. I don't want to stop you here with that question. But I do want to know. I guess. What's your thoughts on that? How would you do that with that small? Would you have to hire like one maintenance guy? What's that look like? I guess just really quick.
Well, with 129 units throughout that market, it would support, full-time property management, full-time maintenance on payroll.
Okay.
So I think that would be fine, right? The kind
Would
of the
you save money,
nuances.
you think?
I think it would be about a wash, but you would be able to improve the performance of the property, right? So things like our turn times and our leasing times and things along those lines, I think you'd see a pretty noticeable increase in that. It really does. I think personally, I think 50 to 100 units more would make me feel comfortable for hiring those two payroll persons, a manager and a full-time maintenance tech, because it's just almost at the cusp of where 129 doesn't truly support that. But yeah, that's something where, after talking to the folks in our group, I think that's something that I got to explore a little bit more.
Yeah. No, I was just going to ask you how many units do you need to hire those two positions? But yeah, that makes sense. 50 to 100, and obviously you're over that. So, so you have acquisitions and you have operations. Right now you've got operations, third party. Acquisitions sounds like you farm most of that stuff out. What's your role and what do you do day to day in that business? Because I know you're a realtor too, but in the investment business.
Yeah, I mean, you're looking at it, man. So like, it's like, of course, I hire some of that out through like 1099s and whatnot, but there's not, we're not like one of these big shops that have got, full acquisitions team and asset management teams and things like that. It's very much more of, I hire out 1099 help when I can, and then, the acquisitions side with the cold calling and the mail, like, of course they help qualify, but once it gets past that, like it goes to me. So primarily like broker relationships, primary asset manager too, which I actually really love. So like we've got the third party management there, but we connect with them on a twice a week basis, basically. And, we're going through the reports, we're going through, our turn times, our collections, our plans for the property, and making sure those are implemented. So I kind of love that side of things, right? It's kind of a little bit of a puzzle piece of looking at your P&L and, seeing where you can cut costs, seeing where you can add opportunities from the top line perspective to make sure that you're hitting the numbers that you're projecting, right? So that's the majority from the investment sides, both the relationships, broker relationships, working with owners from the deal flow, and then the asset management side to make sure that, our properties are performing. And one of our properties, the 77 unit, we're definitely in lease up. So we bought that property in quarter four last year. We dropped it from 85% occupancy down to 46, 47 at the lowest. And now we're in lease up. So we're in mid 60s right now. And it's been definitely a dogfight on that one, but it's a good deal. So it's definitely gonna be worth it. So that's taken a decent amount of the time, just looking at out of the box ways that we can lease up that property faster. So, we're doing, Facebook ads, PPC ads, community events, things like that just aren't, run of the mill, put an ad out on Zillow and call it a day type things for the lease up.
That's interesting. I think, I know in the storage space, people are trying to get, I guess, more creative with advertising. Is that similar with multifamily right now, or is?
Well, I think it has to be with multifamily, because the days of buying a C-class asset and throwing some paint on it and raising rents $100 and, selling in 2 years with doubling your money is gone. Right. So I think, the operations and thinking outside of the box, both from a lease up perspective, from a management perspective, from an income perspective is going to be huge. So one of the things we're doing on the 77 unit that is a little bit new is we bought internet for the property. So we paid $80,000 and had FiberStream come drop lines and all of these units, and we buy internet for $2,000 a month for the entire property. And we sell it back to to the tenants at $70 a unit.
Interesting.
So we're making a nice spread there, and on a cap rate, at 6.25, that's a huge for the valuation of the property. So, I think you've got to think outside the box, both from an income perspective, from a cost savings perspective, as well as like tenant retention and leasing, because a couple of years ago, this shit was pretty easy. And that's not the case anymore. But there's still ways to make money, and there's still ways to run a good business. So I know with storage, when I'm underwriting a deal, for the most part, I'm not figuring in, we've got a bunch of fees. So setup fees, late fees, we got a bunch of those. And then we also have tenant insurance that we can make money off of as well. Are you including, like the bill back for the internet to tenants? Is that included in your underwriting, or is that like cherry on top? Like, this is great, I figured it out afterwards. Yeah, we did. We had a proof of concept that one of our partners had done that on another building. So we factored that in conservatively from a take rate perspective. But yeah, we typically get anywhere from 8 to 10% of our rent roll in ancillary income. So whether that be, pet rent or parking spaces or the internet or laundry or whatnot, we don't factor in like late fees because in an ideal world, we don't want tenants to be late. We want to incentivize them to be on time. So we won't factor in that, even though we know we're going to get, some late fees. We know we're going to get some, deposit retentions and things like that, but we won't factor that in. But yeah, we'll factor in all that additional income that's in the business plan.
Interesting. Huh. Maybe I need to check my underwriting. Cause yeah, I kind of figure that as icing on the cake. I don't figure it in. Now storage is in a different, stage of life cycle than multifamily, obviously. But no, that's good stuff. So you've used 3 different property managers. How much do you think they've been helpful as far as showing you what to do and what not to do? But obviously you're having multiple meetings a week. You've got to be learning something from them that you can take. And if you do bring it in-house, it'll help you, but it's probably tightened your operations as well, just overall, right?
Yeah, totally. I self-managed when I started to on a very small scale on that duplex. I learned a little bit about the self-management space, not anywhere close to like the larger multifamily, right? But yeah, we've learned a lot and refined a lot from these property managers. We had a phenomenal property manager that was a smaller operations, and they just decided to close up shop when their owner passed. So that was kind of an unfortunate one that we had to move on from, but we learned a boatload. One of the biggest things is that I don't think we always knew was important, but we never focused on it, tenant retention, because a year and a half ago, 2 years ago, it was not hard to put up a lease and get 20 applicants, right? And people are just not moving as much now, and especially with the inflation and some of the economic factors that are impacting our tenant base more so than the upper middle class, whatnot. People are not moving. People are very much more price sensitive. So one of our old property managers was very, very big on tenant retention. So before our leases come up, 90 days basically before our leases come due, he's going into those units. He's chatting with the tenants. He's asking, what do you need in this place? If we've got to, replace a fridge versus have a month and a half of vacancy, that's a hell of a win-win, right? Even a lot of times it's something stupid like, we're adding a storm door or some, solar shades on their things for a couple $100, and that makes that tenant super happy, as well as make sure that they're renewing at least, and we're not having to fight vacancy. So that was a big eye opener of like, just focus on tenant retention before you focus on turn time. We were initially focusing on, all right, if we have a vacancy, we're going to turn it and we're going to have somebody in there. By the time somebody moves out to the time somebody moves in, it's going to be 30 days or less. So it really limits that vacancy. Well, obviously if we can have 0 by retaining the tenant, that's a hell of a better situation,
That's awesome. Yeah, that's awesome. I'm trying, while you're saying that, I'm like, how can I implement that in my business? Storage is a little different because it's month to month, but getting customer feedback, especially before they're going to move out or even think about it, that's absolutely huge.
Yeah. If there's any indicators of, people are thinking about leaving or getting ready to move on, then, we want to get ahead of that and see if we can get them to stay.
Yeah, that's awesome. So how did you, I know your duplex you took down as with down payment, use your HELOC. How have you been funding these?
Yeah, so a lot of them, the first couple were partnerships, joint ventures, right? Mm-hmm. Which I think was super, super eye-opening because it was just me and a couple guys throwing in some money and buying the deal, right? So it allowed us to learn on our dime and not other people's money. I really, really hate when people get into this game, especially the larger multifamily space. They haven't bought shit, and all of a sudden they want to start raising millions of dollars. It's like, man, that's risky, and you're playing with other people's hard-earned money, So we got a couple of those first deals just on a joint venture, learned a lot, got a proof of concept, and then we started raising capital. So we raised on the 28 unit and the 77 unit, we raised capital from investors, brought them into the deal, and have a combination of joint venture and syndications.
Gotcha. Awesome. I know you're a realtor as well. What does that look like?
Yeah, man. So so when I left the corporate world in 21 with the 60 units, it was partnerships and things like that. So it's not like, you're balling out of control on cash flow, but I had enough to cover our basic expenses. Right. But I'm also like super ADHD where like, I can't sit still for more than like 3 seconds. So I'm like, get my real estate license and, see what happens. And ended up really quickly attracting investors because I was an investor first. Right. Mm-hmm. So, really quickly started attracting a whole client list of investors, built a team around that. And, for the last 2 out of the last 3 years that I've been licensed, there was a number one agent in the state of Minnesota out of like 26,000 for 2 to 4 unit multifamily. So it's cool because I get to chat with newer investors. I get to chat about financial freedom, which is so freaking important and like just like a game changer, and help people buy those smaller assets to get them started on the road to financial freedom. So it's been an interesting, like, hey, let's just do it and see what happens. So like, damn, this can be really fun and rewarding and, lucrative too. So
that's awesome. Have you, I'm sure you've had people want to possibly invest with you or JV with you on local deals. Have you ventured down that path at all? Thought about it?
I have thought about it. There's a couple clients that I would think about it with, but as you know, like partnerships, man, they're like marriages. They're stickier than marriages. Like you cannot get out of them easy, right? So like I always see people like go into partnerships really willy-nilly and just like, well, I don't have money, so like let's all throw it together. But like that's super dangerous, right? So like I don't go into partnerships until I know somebody and I know exactly kind of what their long-term goals are with the property, what their long-term vision is with their portfolio. So I haven't partnered with any clients. I've had clients jump in on some of the syndication deals. Some of these folks come in and they want to buy small multifamily. They just realize like I, make $300,000-$500,000 at my W-2. Maybe it's not worth it for me to go spend time self-managing, analyzing deals, finding deals and things along those lines. But they still want to invest in real estate. So, we'll talk to them about passive investing in some of these deals. And, it's kind of a win-win. So they get a really solid return. They get the tax benefits. They get exposure to real estate, but they get none of the headaches. So they don't have to do anything. So yeah, it's kind of a nice little dual strategy where there's some overlay there where, if you want to go a small multifamily here, sweet, we can find you a deal. If it's too much work for you and, you still want exposure to real estate, well, you can jump into one of our deals from a passive investor side. So yeah, it's kind of a nice little synergy there.
Yeah, no, I was just, you picked the word for me. I was just going to say that's a great little, I guess, kind of sales funnel in a way where you've got different place to put people, which is awesome. Where do you spend percentage-wise? Where do you spend your time during the week or anytime
on between the two businesses?
Yeah.
Oh, probably way too much skewed towards the sales side. So probably 60-40.
Okay.
When I quit the corporate world and went into real estate full time, and I hear this all the time, people are like, I want to be full time investor. Well, sweet. What does that mean, right? Because if you have your stuff dialed in, like I don't spend more than a couple hours a week on my 129 units. Like and of course, if you're self-managing, like it's going to be a different story. But like if you got your systems dialed in and you got your processes dialed in and your dashboards and the things that you can look at really easy, like it doesn't take a lot of time to run a very efficient portfolio, right? And of course, when we go into acquisition mode, like there's a whole lot more that comes with that. But so like the portfolio is not very hands-on, which is kind of nice. So I spend probably a little bit more time on the real estate sales side and just chatting with new investors, getting people into real estate, run a meetup here and a mastermind group here locally as well. That's super fun with newer investors getting into real estate for the first time, pursuing financial freedom. So that takes up a little bit more of my time. It's more of a passion project, but
yeah, but you can get so many leads out of that.
Yes, 100%. That was never the intention. It has turned out that is definitely an ancillary benefit from it. So like, rule number one is it's always about education and about trying to help people further along. But yes, there's definitely been, both clients coming in from the sales team and clients coming in for the passive investment on that group. So that was never the intention, but it's definitely has come to light for sure. But yeah, that's a group that I'm super excited about because I think, as like it's just once you get like a base level of financial freedom, it like just changes the game like dramatically, right? You operate from a different level of like scarcity and abundance mindset, right? So I think when you see people realize that and you can kind of show them like the red pill or the blue pill in the matrix and they see like there's another way of doing it, like that's super fun and super exciting.
Yep. No, that's awesome. Well, and your heart's in the right place, right? You just wanted to help people. But with that comes the more people you help, the more money you make, right? It's just part of it. And if your heart's in the right spot, like to me, that's just going to 100x it.
Yeah, absolutely. It's just one of those things where like, and you probably feel the same way. Like had I known what I know now 10 years earlier, like good Lord, man, like it would be a different story, right? Like I'm not upset, but like, I think I started investing. I found out about this world when I was 27, 28, something like that. And man, just would have been a game changer. I had to learn it earlier. So trying to like move that needle from where people can learn about this. And like, I learned about it when I hit rock bottom and almost lost my job. Like, you don't have to do that. Like, I think Brandon always says, like, dig your well before you're thirsty.
Yep.
People should be doing that, right? Like, focus on this stuff now before you absolutely need it. Cause it's a hell of a lot easier to build this when you're not dying for it, versus like, oh shit, I lost my job, or damn, I'm in a position where I absolutely freaking hate, like I need to build my way out of it. It's easier to architect it ahead of time.
It is. But to your point at the beginning of the show was you needed that pain to push you. And that's why I see all the time is like, yeah, it's great to dig your well before you're thirsty in this aspect to, get in the real estate investing or something that where you can control your own future. But if you don't have that pain or that huge goal or that huge drive, like, doesn't matter. People are just aren't going to do it. So. Yeah,
that's one that I've been struggling with for a long time. Like, there's like, for me and for a lot of people, it's a catalyst of like pain. But like, how do we paint a picture of this new way of living that can be so beneficial for you and for your family, that it makes people want to go towards it versus running towards that pain or away from that pain, right? And I don't think anybody's cracked that code yet, but man, we shout it from the mountaintop, right? But like, until we can figure out how to get people moving towards that, man, that's going to be the game changer.
Yep. Well, we're indoctrinated, right? Like, we're taught from beginning to go get a job, work till you're 65, and maybe I don't even think I was taught to contribute to my 401k, but at this point, like, there's not going to be Social Security, so you got to at least do something. Dude, but we're taught that's the path, and then people like us, we, something happens painfully to where it's like, I know there's something else out there where I can control my destiny, financially speaking, and we go down this path, but a lot of people just don't.
Yeah, and it's kind of like a slap in the face when you do the things that you're supposedly supposed to do, and you get the good job, and you're 10 years into it, and you're like, well, shit, like, this is not the only way to do it, and you're just a number on a spreadsheet to those big companies, and they pull the plug out, and they're just running a business, right? So like, no fault on them, but it feels so cheap, right? And so used, but it's just a game changer when you realize there's another way of doing it. And like, did you see? I posted something the other day about this, but did you see they raised the official retirement age, and at the same point in time, the life expectancy for Americans is going down. So for the first time ever, we went from, I think it was 78 to like 76 from an average life expectancy, and they're talking about raising the retirement age. It's like, well, man, we're just shrinking that gap of what we think we get to enjoy at the end of our life. So it's like, it's another way to do it.
Yeah. Well, and we know that once you do hit retirement age, you ain't enjoying it. Like, you're unhealthy. You can't move. You can't travel. Like, there's very little that you can enjoy.
Yeah. Yeah, absolutely.
So we'll start wrapping up here. What's next for you?
Man, good question. I think, after the last 6 months have been very interesting, and shifting more of my time onto doubling down on the investment front, right? So I've been doing this kind of like this 50-50, like this foot in two canoes, if you will, on the sales team and the investment front. So really want to double down on that and scale that. So 4 deals this year is the goal. Two joint ventures, two syndications. So that's the goal for this year, and really finding those, kind of those value add, those opportunities that we found in the past that we can, force that equity. And then, I still love doing the thing that I'm doing here with newer investors and the sales teams, but outsourcing more of that. So I'm less in the day-to-day and more just in the education side of it, the speaking side of it, and like the initial consults, because I love doing that. I don't think I'll ever get away from that. So that's it, man. And then like really just kind of enjoying the ride. So I think for the like 10 years, from 2013 when, I had that fun conversation about, finding a new job, to really like 2021, 22, like I don't really focus on much other than like finances, which is kind of sad. So like, trying to enjoy the ride a little bit more with travel and with taking some time off, which is why I love the group that we're part of, right? Because you get to, you're forced to do 4 trips per year, and you get to hang out with some pretty cool guys and some pretty cool places, and it's not like a vacay. You're growing, but it's a different type of work. So that's it. That's kind of the next year or so.
That's awesome, man. That's exciting. That's a really good answer. It might be not talking bad about anybody else, but that's been on the show. That's might be one of the top answers that we've had. What's one thing that you're better at than anybody else?
I don't know if it's probably not a tactical answer that you're looking for, but I do really, the self-reflection and the pivoting, right? It's like, I'm totally, like I said at the beginning of this, like I'm totally fine admitting I'm wrong if new information comes out, right? And I think that, that helps me in a lot of ways of just like being able to realize that shit's changed and like, okay, now this is the truth, right? You got to make the best information. You got to make the best decision with information they have, right? And I think sometimes people get, I don't know if it's an ego thing or they just get so just stuck in like, this is what I said I was gonna do, so I have to do it, and I have no issues shifting if things change. So that's a huge business quality. That be amazing how much better businesses would be doing if they did that, and how many businesses would fail less and go bankrupt less if they did that. So yeah, right. I mean, there's 100%. I mean, the corporate world, it's even worse, right? Like you have initiative, like 2-year initiative, and like you're 4 months into it, 5 months into it, and you see the writing on the wall, but like those VPs are so damn egocentric, like they can't admit like this was a bad decision. So they keep driving their company to it, and go figure 2 years later, they lost, millions of dollars, and, it didn't work out. So if you can learn early and figure that out early and pivot accordingly, you'd be 10 times better off.
100%. Well, and I heard this, actually, I think it was Kid Rock that said this. Whether it's true or not, I don't know. But I heard that if you want to change the design, like any small thing on a car, like a Ford, Chevy, you name it, it takes like 3 or 4 years to change that one thing, right? The bigger you get, the harder it is to pivot and move. Like you're trying to turn the Titanic, and it takes longer. So there is something to be said about being, I won't say smaller, but at least in a nimble phase to be able to pivot like that.
Dude, totally. And there's a lot of companies now, especially in the tech world, because at the end of my corporate career, I ended up in the tech field, and I would challenge anybody to go look about learn about how new software companies are started up in the Scrum or the product model, where they really test and measure, and they pivot really quickly. MVP is something that's huge, minimum viable product, where like you got to get something out there and test it and see if it works without spending 2 years of building this thing. So instead of you spending a year building this big, massive, huge plan about your investing portfolio, about what you want to do, just start with the end in mind, buy a deal, see if it works, and kind of pivot accordingly. So you're right. You got to be nimble instead of being like this massive behemoth, like stuck to one path. Being nimble is way better.
That's awesome, man. That's awesome stuff. So if anyone's got any questions, wants to reach out to you, where can they find you?
Yeah. So Instagram at Mike Mo, REI, MikeMoe, REI. SuperiorCapitalGP.com is a place to go to reach out as well. But or shoot me text 218-310-5947. Never shy away from a conversation with people about real estate or personal finance, development, whatever. I always love it. So always happy to chat with people.
That's awesome, man. That's very giving that you gave your phone number. It's all right. Audience isn't that big anyways. It's growing though. So and appreciate everyone that's listening. Appreciate everyone that's sharing as well. But appreciate you coming on here. This is an awesome conversation, man. And again, thank you.
Yeah, man. Appreciate you having me on, and appreciate everything that you taught me over the last 6 months that we've known each other. So yeah, it's been awesome knowing you, man. Appreciate that, man. All right, we'll see you guys next time.
Thanks for following, subscribing, and listening to this episode of the Do More podcast hosted by John Farling. To learn more or ask questions, go to l4investing.com.